Okay, and we're back. Yes, just reminding you, it is Talking Mortgages. My name is Mclean. I'm the mortgage MC. And the numbers for you to reach us via WhatsApp is 825-343-4486. And you can, even though we're talking about interest rates, any question you have on mortgages, you can just shoot us a text or give us a call. We'll be so happy to answer those questions, whatever it is. So you might be thinking about getting a mortgage soon, and you have some gray areas that you want to clear up or anything that you're not sure about. Give me a call. Let's talk about it. But today, as I said, we are talking about interest rates, variable versus fixed. And it is sometimes very difficult to choose between the rates, right? So fixed rates, basically, with a fixed rate, your mortgage or your interest rate stays the same during the length of your term. And no matter what else happens, if you have a fixed rate for 1 year or 2 years, because fixed rates sometimes are for anywhere from 6 months to 10 years, with the most popular being a 5-year term, because that's what a lot of people choose. But no matter what happens, so if you had a fixed rate for whatever the term was, 1 year or 3 years or 5 years, and the Bank of Canada governor comes and he raises the rates, your rate does not change, right? So that's one of the advantages of having a fixed rate. And the one key feature of fixed rates is that those rates, in staying consistent, the same amount of money you're gonna pay every month for your mortgage payment, and a great proportion of that is gonna go to interest or principal, but it's gonna be somewhat consistent, because no matter what else is happening out in their environment, your rate truly does not change. Another key feature about fixed rates, though, is that fixed rates are usually, when you check the rates on any given day, they're usually a little higher than the variable rates. And that is because you get the added insurance of stability and consistency. So they are usually a little higher than variable rates. Right, so now that we have a better understanding of what fixed rates are, let's look at what variable rates are. And variable rates, these are appealing because they're typically a little lower than the fixed rate. However, what happens is that every time the rate increases or decreases from the Bank of Canada, or what the lenders will say is their prime rate, and their prime rate is a rate that's the rate, but it is usually discounted for the variable rate. So say the prime rate or the rate that the prime rate is usually a rate that the lender ties to the bond rate. And I won't go into all of those economics, right? I'm going to try to keep it as simple as possible, right? Keep it simple, sweet. That's what I'm going to do. So the prime rate is the posted rate that the lender has. So they'll say, all right, our prime rate is 3% for argument's sake. And the variable rate is prime, which is the 3%, minus 0.5%. So then the variable rate would be 2.5%, right? And prime rate might be the rate that you're getting it fixed at, right? So the variable rate usually is a little lower. And if what is happening in the market, if the rates go up, then your rates go up too. If the rates go down, your rates go down. So you benefit when there's a decrease in rates, and you suffer the consequences when there's an increase in rates, right? Because like right now, persons with fixed rate mortgages are sitting and wiping their brow, breathing a sigh of relief. But persons with variable rate mortgages, they have seen their rates move, and it has moved tremendously over the past 6 to 8 months. And what happens when the rates move, when the rates go up, what happens is that more of what you pay goes to pay interest, because now the interest portion of your monthly or your biweekly or your weekly payment amount goes to paying interest. And what happens is that if you're paying $1,000 and it was normally like 600 going to interest, 400 going to principal, and the rate increases, what might happen is that now 650 goes to interest, 350 goes to principal. So if the reverse happens though, where the rates go down and you had 600 going to interest and 400 going to principal, what would happen is that the rates go down. So now, say there's a $50 difference, like in my first example, what would happen is you'd have $550 now going to interest and $450 going to principal. So you'd benefit. One key thing that we need to remember with variable rates is that while your repayment amount will remain the same, what will change when the interest rate changes is the amount that goes to principal and the amount that goes to interest. There might be a point when your payment amount might be increased, because if there's at some point where everything goes to interest and nothing goes to principal, then that is a point where usually your lender will call you in and say, listen, we need to make some adjustments and we need to ensure that monies are still going to principal, because your payment should be principal and interest. Right. So that's for variable rates. So just to run through the pros and cons of both fixed and variable. With fixed rate, pros, stability. You know exactly what is going to your payment, and you have a fair idea as to how much of it is going to interest, how much is going to principal, and that is locked in for the term, for whatever term you have, whether it's 6 months, 1 year, 2 years, 3 years, 4, 5, 7, or 10. All right? It is predictable, right? You can plan on it. You can say, listen, for the next 6 months, I'm working at this place and I'm going to be getting this amount of money as income. And I know that my rate is going to be this. My mortgage is going to get paid by this amount. This amount or about there approximately is going to go to interest. Another amount is going to go to principal. So I know that, yeah, I'm able to pay off my mortgage at X time. It's predictable. You can plan on it. Or you know that over whatever period, you'll pay what amount for interest and what amount for principal, right? With your variable mortgage, before we go to variable, let's look at the cons of having a fixed rate. And the drawbacks of a fixed rate is that, one, potentially you're gonna get higher interest costs when you compare the interest on at a certain point in time, because usually, as I said before, variable rates are lower than fixed rates. Plus, if there's a drop in the interest rate, you don't benefit. Over time, because your interest rate is a little higher than the one that you would have gotten at the same time if you got variable, you might end up paying more in interest costs. So that's a drawback of that. And one of the most important drawbacks is that with a fixed rate, if you break your mortgage before the term comes to an end, what will happen is that your penalty, we have one of two penalties that you pay for fixed rate. And one is either you pay 3 months interest, or you pay what is called the interest rate differential, which is the difference in the interest rates when you got the mortgage as against what the rate is today, and multiplied by whatever amount you have left to pay, right? And that can work out to be somewhat expensive, as opposed to whether or not you would have just gotten 3 months interest at simple interest. Right. So now to look at the pros and cons of having a variable mortgage. So with a variable mortgage, potentially lower interest, lower cost over time because your interest rates are usually a little lower than the fixed rate. And when I say low over time, I'm going to ask you to take that with a grain of salt. Because if the rates go up over time and it now becomes higher than what you would have been paying if you had a fixed rate, then that advantage goes away, right? All right. Another pro for having a variable rate mortgage is that if you break that mortgage, your penalty is simple. You pay 3 months interest. Whatever that works out to be, that's what you pay, right? Plus, a key advantage of having a variable rate mortgage is you can, at any time with most mortgages, switch your variable rate mortgage to a fixed rate mortgage, right? So, for example, those of us who have variable rate mortgages and since the last 6 to 9 months, the rates have been going up. What you could have done is that you could have called your lender or call your mortgage broker, or if you had a mortgage broker that's like me, I would call you and say, listen, I remember that I got your mortgage and it's a variable rate mortgage. So the rates are going up, and based on what we see, they're going to continue going up for the short to medium term. I would advise you to switch and take a fixed rate, and we would crunch the numbers and see what your savings, your possible savings might be. And if there's savings to be had, I would strongly advise you then to do the switch, right? Because that's the added value that a mortgage broker will bring to the table. Your bank is not going to call you and say, listen, interest rates are going up. Come in and let's just switch over your mortgage. No, they're not going to call you. Only provider that will do that is that if you have a mortgage broker, and if your mortgage broker is Mclean, the mortgage mac, right? So let's look at the drawbacks now of having a variable rate mortgage. It's not stable because whatever happens in the economy can affect your rate. It can go up, it can go down, right? When you're converting to a fixed rate mortgage, it might be costly because then the rates might be a little higher than what you're paying presently. So it might cost you some money, right? But at that point in time, over time, it might not be, but it might cost you some money there. All right, so great. So now that we have understood both types of interest rate, and we know the key features of them and the advantages and disadvantages, what we're going to be looking at now is how is it, because you're there saying, yeah, that's all good and well, Oral, but how is it I decide which one I go with, right? And I'm going to tell you that right after we take this short break. Remember, this is HGG Radio. My name is Oral Mclean, and you can call us at 825-343-4486, or you can send us a WhatsApp text message with any question that you have, and we'll answer it. If you believe interest rates are going to drop, then it's best that you go variable. Because if interest rates are going to drop in the short to medium term or even the long term, you go variable and you can then enjoy all the benefits of the rate dropping and going down, down, down. Right? So, another thing is your risk tolerance. And your risk tolerance is that some people say, yes, I'm a risk taker. Some people say, I don't like risk. I don't take risk. I like to keep it safe. Yeah. Right? So, what you do, because of your risk tolerance, if you are conservative in your thinking and your approach, then definitely you're a fixed rate mortgage person. However, if you're a risk taker and you don't mind monitoring the environment to see when things are changing and taking a chance that, listen, rates are going to remain the same or they're going to go down, yeah, if you are a risk taker, you can go variable, right? Because, yeah, if they say, nothing venture, nothing gained, right? So if you feel that you can take the chance because yeah, you might end up saving lots of money when you benefit from rates going down or them not going up. All right. Another thing is the spread. And when I say the spread here means the difference between the lowest rate that is fixed, the lowest fixed rate, and the lowest variable rate. And if, say, you have a spread of a 0.5% or a 1%, that if the spread is significant, right, then it is an easy decision to go variable. But if the spread is close, right, say the spread is probably like a 0.2%. That's virtually the same thing, right? So why are you gonna take so much chances for just 0.2%? If it's a 0.5%, 0.75%, or 1% or 2%, yeah, by all means, go variable. But if they're very, very close, it is good to just go with fixed because it's more stable and you're not getting the savings that you're getting by going variable here and taking more chances is not worth the effort because they're so close, right? So another thing is that you may have a plan that you're going to break the mortgage before the term ends. If you're going to break your mortgage before the term ends, then you are going to think about the penalties of breaking. And in most cases, the penalties that come with variable rates usually, in most cases, are lower than if you have a fixed rate because you have two different penalties and they choose the one that is the highest, right? So if you're thinking about doing that, then going with a variable rate can be the thing. So those are some of the major things that you're going to look at. And you're looking at them from your personal perspective, and that is your risk tolerance, whether you're a risk taker or you're a conservative. You're going to look at it from the environmental factors. And when I say environmental factors, I don't mean global warming. I mean the political environment, the social environment, the business environment, the economic environment, right? What is happening around you in the marketplace or in business and all that. Whether there's a war in the Ukraine that is going to affect oil prices and that is going to send up inflation, which in turn is going to cause interest rates to rise, right? Stuff like that. You're looking at the environment to see what might happen to know what to do, or you look at the interest rate themselves to see the spread between it. And yep, that's some of the major consideration when you go and think about fixed or variable. Right. So that's my 2 cents as it relates to fixed rates versus variable rates. I'm hoping that we have a question or two.
I see a question here. It says one principal can get a mortgage with only one income. Can the applicant change after considering fixed rates to variable rates?
All right. So the question is, and I'm going to sum it up easy. It sounds to me that they're asking if you have a fixed rate, if they can then switch to variable. That's a more difficult thing to do, to switch from fixed to variable than to switch from variable to fixed. Right? It is more difficult. It can be done, but we call that a refinance, right? And what you're going to do there is that you're going to break the mortgage. And remember that we are saying that when you break your mortgage before the period ends and you have a fixed rate, it is likely that your penalty will be higher than if you had a variable rate. So it is a little tricky to switch from fixed to variable because you're gonna incur cost, right? But it's easier because it's written into most contracts that you can switch from variable to fixed, right? Because the incentive is switch from the lower one to the one that might be a little higher, right? So that's the thing. So if you switch from fixed to variable, you're breaking your mortgage before the term ends, and you might incur costs. You might not incur costs that is significant if based on what is happening. And these are the circumstances under which you might not incur a lot of costs. One, If the rates, that the posted rate at the time you took that mortgage and the posted rate now, if those are pretty close, then you might get away with not paying too much of a cost, right? Because you might be doing it now because you anticipate that rates are going to go down soon, right? So if you think that breaking that mortgage and the penalty that comes with it is going to be lower than the savings that you're going to get when you switch from fixed to variable, and then the rates might go down and you're going to save way more money, then that's a very good thing to do. So in switching, you're going to weigh the costs of switching, which is the switching cost, which is the penalty, against your potential or possible savings that you're gonna get because you've switched from fixed to variable. All right, good. Any other question? All right, good. Very good question, though. I love that question. All right. Mortgage tip of the day. If one of your objectives is to pay off your mortgage much quicker than your amortization is set, and that is the life of your mortgage, one way to do that is to use accelerated biweekly payments. And these allow you to pay off your mortgage earlier than the set number of years. And if this is done properly, you can probably pay off your mortgage in a lot of cases 3 to 4 years quicker than if you just make your regular monthly payments, right? Or even if you're making bi-weekly payments that are not accelerated. Yeah. So that's our tip of the day. All right. So as usual, we have nice things to give away. And today we're gonna be giving the goodie to the person that sent in that very, very wonderful question. All right. So my producer, please take their information and we will send them their gift card. And as usual, we have a Tim Hortons gift card. I see we had some problems getting access to our Starbucks gift card that we normally have. So for now, we're holding off on Starbucks because there are some technical problems getting through to their site to get that card. All right. So hope you enjoyed the program. Again, this has been Talking Mortgages. My name is Oral Mclean, and I'm the Mortgage Mac. And I'll see you again next week when we'll discuss another very, very interesting topic as it relates to mortgages. Until then, walk good.